Hi, and thank you for watching us here at Tax Talk UK, where we talk about all things tax and consider other important aspects of working for yourself, being self-employed, running a small business. So today I'm going to talk about the one of the VAT schemes, the fixed rate scheme, FRS for short. Before I talk about that, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as being able to access other information that we have available on a whole host of different topics, all aimed at supporting you in your self-employment. If you head to the playlist section of our channel, our YouTube channel, you will be able to find the information all catalogued loosely in the playlist. So this should help you to find the information that is most relevant to you. So on to then the VAT scheme, the flat rate scheme. So first thing to mention, as with any of the VAT schemes, so VAT registration and whether you need to be VAT registered, there are obviously some rules surrounding those. And if you have to be VAT registered, then you have to be VAT registered. But the VAT schemes are schemes that are in place to support VAT registered businesses, and they're not obligatory. If they don't suit you or your specific individual business, then you don't need to be on those schemes. The schemes are designed for people who they do help. So quite often when we talk about VAT schemes, we do get some comments that that this wouldn't be preferable for my business. So the simple answer is, if it's not preferable for your business, if you're going to pay more VAT under the scheme, then it's not right for you. Then you just simply don't use that scheme. The schemes are there for you to use if they do help. If they do help you. So that's really important to say. So the flat rate scheme, okay, so ordinarily for VAT, you are going to charge VAT on your sales at the appropriate rate, and you are going to pay VAT on some or all of your supplies and purchases. And at the end of your VAT period, you're basically going to report to HMRC all of the total of all of the sales VAT and the total of all the purchase VAT, and you're going to pay to them any difference, or obviously have a refund if the purchases are more than the sales. So that means although it is it's now mandatory to be complying with Making Tax Digital, so most people in that scenario will be using software. It's still necessary to itemize every transaction that makes up that total purchase reclaim. Now, the idea of the flat rate scheme is to simplify that calculation for people. So rather than actually adding up all of your sales and all of your purchases, the VAT elements, now you only have to add up the sales and the purchases, rather than claiming them all individually and adding those up. You would apply a percentage, and there's a variety of different percentages which are aimed to be an average of what would be expected for certain industries. So I'm going to pop the link in the description to the list of the different industries and the percentages that apply. But just to just to give an example, because I feel it's always easier to understand things with an example. If for example you made a sale of £100 plus £20 VAT, so 20%, So the total receipt from your customer is £120, that being £100 sale and £20 VAT. Let's say, for example, that then you have £20 to add on your VAT return and pay to HMRC. And in the traditional method, you would separately be adding up all of your purchases. But let's say, for example, that you paid out £8 in VAT to a supplier, then you would take that £8 off the £20 and you would be paying £12 to HMRC. So how the flat rate scheme works is, let's say, for example, that your flat rate percentage was 10%. Now, in that scenario where you've made that sale of £120, £100 plus £20 VAT, then using the flat rate scheme, all you would be required to calculate would be the £120, and then your flat rate would be what you would pay. So the 10% of £120 would be £12. So you would be paying £12 to HMRC, regardless of the exact amount of the purchases. So in the example that I gave, where you had £20 sales VAT and £8 purchase VAT, that is £12, and the 10% comes to £12. So you can see that you would pay exactly the same amount of VAT using either of the schemes in that example. But if you were using the traditional accounting and you had a VAT reclaim of more or less than £8, then you can see why the 10% would be an average. So this is why it's important to understand your percentage and understand your individual business, because it may be that you something in your activities means that using the average rate as given by HMRC isn't beneficial. So if, for example, in that scenario that I just gave, you had £10 VAT to reclaim, and you are paying £20, then you have £10 to pay. So you can see on the flat rate scheme for your 10%, that obviously the 10% is just for this example. It's each industry has its own percentage. Then you would pay £10. So you can see on the flat rate scheme, you would be paying more VAT. So it's important to check what the percentage is for your individual industry, and to understand whether that is going to result in the correct sort of level of payments to you. If it, as I explained at the start, the scheme is just there to help people, and if it does so, if it means that you would pay more VAT on the scheme, then you just wouldn't subscribe to that scheme. You would continue doing the VAT using traditional methods. So as I say, the percentages are what HMRC, their data shows us an average amount for your specific industry. So they're not, so it's generally intended to be a useful scheme. So as I say, I'm going to pop the link in the description. There is a generic, if your industry doesn't fall into any of the categories given, it is important that you use the correct category. If another category gives you a lower percentage, but it doesn't correctly define your industry, then as once that is identified by HMRC, you will only have to pay the under declared VAT. So it is important to ensure that you do choose the right industry and the category. And there are some things to remember, some eligibility criteria. So there are, if you use cash accounting for VAT, there is an alternative, but you can't just use the standard fixed rate scheme, which essentially is the same as the difference for standard accounting. So you're going to be calculating the percentage on what you've been paid rather than what you've invoiced, and the same for paying out. There are income turnover thresholds that once you meet those, that you're not able to stay within the scheme, and you can't join the scheme if you are already over those. And you can't always use it with other schemes. So if you're on, for example, the margin scheme, you can't also use the flat rate scheme, although when you actually consider what that would mean, then that would be fairly self-evident. So it's important to remember that if you are buying assets that are under £2,000, including the VAT, then you won't be able to claim the VAT specifically on those items if you're on the fixed rate scheme. If you join the scheme when you're newly VAT registered for the first year, you are entitled to an extra, a reduction of 1% off your industry, percentage. And then once you're on the fixed rate scheme, so if you decide that this is correct for you, then you simply would be putting your sales VAT would actually be the percentage. So in the example that I used before, where you have total gross sales, so the net and the VAT of £120, and so £12 is the VAT. So that would go in the sales VAT box with the gross figure in the sales. And the important thing to remember is then in that scenario you would have been accounting for the VAT in your accounts, but you would actually make a profit in effect from the difference, and this would just be added to other income in your account. Because so again in that scenario, the sales that you have made are going to be accounted for the same as if you were using traditional methods, but you wouldn't be accounting for the purchase VAT in your accounts. So therefore, in that scenario, you would have collected £20 VAT from your customer, but you're only paying £12 VAT to HMRC. So that £8 would need to be accounted for as other income in your accounts, otherwise everything's not going to balance out. So as I mentioned before, the fixed rate scheme, as with all schemes, is optional for you to join if it suits your individual business requirements. So how it works is you pay a fixed percentage of your gross sales to HMRC, and the percentage you pay is determined on your industry. I'm going to pop the description in the description. I'll pop the link so you can find your own. And just a quick mention on when you're working out your rate, what's known as limited cost business. So if the purchases that you're paying out are either less than 2% of your total turnover or less than £1,000. If it's more than 2%, then you are deemed to be a limited cost business, and that gives you a higher percentage, even if your industry is a lower percentage. If you meet the criteria of the limited cost business, you must pay that higher rate. But that is all in the link, and with the rates, that has got that information in there too. So hopefully this helps you to understand how the fixed rate scheme works, and you will be able to go away and work out if that is going to be beneficial to your business. Thank you for watching. As I mentioned, please do subscribe to the channel, and if you found the information useful, then please do like the video. Thank you. Goodbye.